All right, all right. Good evening, traders. Happy Thursday, everybody. It is good to see you all. Welcome, welcome. You should be seeing my screen. Looks like we have a new face, Stanley. Welcome, welcome. Glad to have you. Good evening, Perry. Good evening, Stephen. Good evening, everybody. Good day. I'm telling you, man, we had a good read. People are like, are you going to put some trades on even on Fed Day? I'm like, yeah, I think I am going to put a couple on. Huh? And it's been a good week. Posture's bullish. We're bullish. Making money bullish. Glad to hear that's good. Everyone doing all right? Let me know. I'm going to give it just another minute. I got a couple of people's audio getting ready to turn on. So let me know. How's trading? How is it going? Inquiring minds want to know. Give me 1 second. I'm actually going to copy our link and just go drop it on Discord. I like to do that just in case there's somebody there. Link starting now. Boom. Okay. Okay. All right. Well, let's get cracking. We got a lot to cover today. Today is a presentation day. On Tuesday, what day is today? Today's Thursday, all day. On Tuesday, we did an application day for selling options. Took a couple of trades on homework last Tuesday. One is hanging close. The other's almost 2-1. Love it. Love it. Love it. Good stuff, Stephen. Welcome, everyone, to the Options Foundations 2.0 course, where today we're talking about spread trading. Spread trading. If you're just jumping in, you're jumping in the middle, which is fine. But we've been putting together building blocks. So if you watch this presentation and you're like, oh my gosh, that was a lot, you probably want to go back and catch up with those building blocks. So the building blocks start with just basic options information, terms, definitions, characteristics, right? We're talking about, terminology that makes sense. We're talking about rights and obligations and assignments and everything along those lines. Yeah. Then we start building into the basics. What are the basics? Buying options, buying calls, buying puts. That's the first easiest perspective and consideration in the context of options, is to come at it as a buyer. You have rights. Then after we did that, we switched gears 180. And the last two sessions were focused on selling options. We talked about covered calls. We talked about cash secured puts. We talked about naked puts. Now, this is where the building blocks really start to come into play. Now, we're going to take one of those naked puts and we're going to hold it up as the driver of a trade. Then we're going to take one of those buying options. So I'm going to sell a put, then I'm going to buy a put, and I'm going to put it together. And what's that going to become? That's going to become a bull put spread. We're going to talk credits first, and then we'll move into debits next time. I've said this before. I will say it again, over and over and over again. Credit does not mean better because you're getting money to you. Oh, you get paid on day one. We went through this. You don't get paid. Money comes into your account that then gets held. And they take some of your money and they hold it too. Now, as we look at the potential of a spread trade, what we're doing is saying, hey, I don't want to have this huge margin requirement for a naked put. What can I do? Well, you can hedge it. You can hedge it by buying an option that covers. That gives you, it's now it's covered by the option. We don't call it that, right? It's not called a covered option trade. It's called a spread. Right? We buy one, we sell one. So today we are going to get into the concept of spread trading, and we will go from there. Now, remember, I prefer, if you can, ask questions along the way, and I'll be watching the chat and I'll be looking to address those questions as we go. In the meantime, if we don't get to your question, I will make sure we have a little bit of time at the end, but that's the way we want to go about it. Here's the disclaimers. As always, remember, education, illustrated purposes only. We're not brokers. We're not advisors. We don't give recommendations. We don't give guidance. Every trade you take is your own and should either be consulted with somebody or just accept that you're getting into something. Okay, today's agenda, intro to option spreads. And we're going to start exploring spread trading. What are we doing here, right? Why? Why spread trades? Why do I need to complicate things and add a leg or 2 legs or 3 extra? Why do I need to do that? What's it going to do for me? And so you can see, we will talk about the advantages that spread trading gives you. Where are we going to do it? We'll talk about the potential risks of spreads. What could go wrong? Then we're going to talk about putting it together and describing and understanding what makes a credit spread. What is it? What is a credit spread? When we understand credit spreads, then we'll be able to flip it around and understand debit spreads better. We have 2 types of credit spreads we're going to discuss. We have bull put spreads. Pretty self-explanatory. You're bullish, you're using puts, it's creating a credit, bull put spread. And we have bear call spreads. You're bearish, you're using calls, and it's creating a credit. So if someone's like, oh, I'm going to do a bullish credit spread, and you're like, oh, well, shouldn't you do a bull put spread? It's the same thing. It's the same thing. So you'll hear a lot of times when people are describing things, some terminologies can be used interchangeably. It's important to recognize that. What are our considerations for spread trading, right? What would make us decide, you know what, I think this makes more sense. And then we'll summarize. And this will be great because this will give you a little bit of time to absorb, maybe watch the recording a second time. Because next Tuesday, when we have our Options Foundation meeting, we're going to dive into application, right? Application. And with it being application next week, it is very, very unlikely that we talk about bear call spreads. Why? Because we're not bearish. It's pretty simple. Because I am not bearish. I'm not looking for bearish trades. If I take a bearish trade, it's going to be from a hedge. And yeah, you know already, anything you've hedged this year, it's been tough hedging. The market's not been really conducive to that. All right, so let's dive in. Intro to options spreads. What are we doing? What is the definition? And you'll actually hear people say the word combinations, option combinations. That's what spreads are. You're combining a buy and a sell, 2 buys and a sell, 2 sells and a buy, 2 buys and 2 sells. There's a lot of different combinations that you can string together in options to make new strategies. But what we're doing is we're combining buying and selling 2 or more, right? Vertical spreads, 2. Horizontal spreads, 2. Diagonal spreads, 2. Butterfly spreads and iron butterfly spreads. That has 3 contracts. Broken wing butterfly, 3. Iron condor, 4. Traditional condor, 4. Broken wing condor, 4. So we're starting with 2. We're going to get comfortable with 2, and then we'll move to the advanced spreads here in a couple of weeks. We'll start to add more. But what we're doing is we're using the same stock, not necessarily the same expiration. That depends on the strategy. Mostly the same expiration, But when you start doing time spreads like calendar and diagonal spreads, you will use different expiration dates. Now, what are we trying to do? Well, we're trying to profit from the relative movement between the two options, not necessarily just the absolute direction of the stock itself. What does that mean? It means that when you buy an option, your direction, right? Price is working for you, time is working against you, and volatility is going to be uncertain. But in this situation here, we're saying, hey, you know what? This might not be a directional spread. It might be a non-directional. It might be a somewhat directional. So we're starting to try to take advantage of things like time and volatility in addition to the direction of the stock itself. The benefit, reduced directional risk compared to single option positions, right? And so you can think of it as capturing the dance of options rather than betting on a single outcome, meaning over time, you're looking to raise your probability. Are you sacrificing potential to do a spread? Yeah, absolutely. We've talked about this, the concept of recognizing the pawns. In any situation in trading, something will get sacrificed. And with that sacrifice, you will likely gain something for what you're losing, right? That's true here. If I choose to do a spread instead of buying the option, what do I sacrifice? Unlimited upside potential. If I buy a call, that stock could go up forever and I could make money on it the whole time. Is it likely to happen that way? No, it's not likely to happen that way, but it's possible. And I lose that possibility, right? We control our risk better. And in order to do that with these spreads, we sacrifice some of our gain. That's the pawn, right? So you're saying, you know what? Yeah, it's worth it. It's worth it to sacrifice buying the option because I get time and volatility on my side because probability is substantially higher, right? What's an example? If you buy a near-term call and you sell an out-of-the-money call on the same stock, what's happening is the option, now that would be considered a debit spread. That's not an example of a credit, but that's okay. It's an example of a spread. If you buy an option that's at the money and you sell one that's out of the money, the one that you sold is actually reducing the cost of the one you bought. So it's as if you paid less for that initial position. But the one that you sold is now the cap, right? If I buy a $50 call and I sell a $60 call and the stock's at 53, let's say, if that stock goes to 70, I stop making money at 60. I capped it, just like I capped things last week when we last week when we talked about covered calls. You cap it. You're not going to keep making money on that. If you want full upside potential, you buy the stock or you buy the call. If you want to hedge that with time and volatility more on your side, then you do the covered call or the naked put, or you start to do the spread trade. So again, what we're doing here is saying, you know what? Yeah, it sounds great that I can make unlimited money, but are you ever making unlimited money? Are your calls just soaring? Just nope. Yeah, it's all up all the time. Probably not. There's probably some struggles. When you have a struggle, a spread will do better. Period. Every time. Okay, so that's the why. Now let's explore it a little bit. What do we have? So this is from a directional standpoint. I have bullish spreads. That capitalizes on bullish expectations. That might be buy closer to the money call and sell an out of the money call, or it might be sell an at the money put and buy an out of the money put. Either one of those. One is a bull call spread, that's a debit. The other is a bull put spread, that's a credit. So you'll hear people talk about spreads as put spreads and call spreads. You'll hear them talk about spreads as credit versus debit. You'll hear people talk about spreads in their direction, bullish, bearish, or neutral, which is a calendar spread. That's what's tough. I'm going to tell you right now. There's no like, oh, I intuitively know. Nope, you got to just memorize it. You got to just study it, memorize it. Or, and this is not the advice a lot of people want to hear, or don't trade options. But don't dabble. There's no such thing, right? There's no such thing as dabbling. Oh, I dabble in options. Oh, dabble in that context is another word for lose money. I dabble. I dabble in golf and I curse a lot while I do it. Let's not dabble. Let's be very specific and very focused on what we're doing. So we have bull spreads. It's directional. We want it to go up. That's bull call. That's bull put. That's a bullish diagonal spread, right? And we have the ability to put a little extra direction or a little less direction. That's the great thing about options and spreads is we can really fine tune price, time, and volatility. So if you look at an option, you're like, oh, the volatility is high. That means options are expensive. Think about a spread. Or if you think, oh man, this trade is probably going to take 2 weeks. Ooh, when you hit 2 weeks, you really start to see your time decay reduce your reward to risk. And you might think, you know what? I think I might do this spread. I might sell this thing. And so it's context of time and volatility that open these things up for us. Bearish spreads embrace bearish tendencies, obviously. We could sell a put and buy one out of the money. We can, so that would be a, we buy one, we sell one, and that gives us a bear put spread. We could also do a bear call spread. That's the credit spread. That's the one we're going to talk about here today. And lastly, we have calendar spreads. I love calendar spreads, you guys. We actually, interestingly, and maybe we'll start, you'll see calendar spreads come in the alerts, by the way. But we did a calendar spread last time. Just threw one on right after we did the class. That spread made 170%. So a lot of people are like, maybe it wasn't quite that much, but a lot of people are like, oh, spreads, they don't do as well. That's just not true, right? From a reward to risk standpoint, that's just not true. They can do absolutely phenomenal well. To make the most profit from a spread, this is a question that came in. Is it best to have it expire between the two trades? No. If it's going to expiration, we want it to be in the money if it's a debit spread, or out of the money if it's a credit spread. That's max gain, right? And so today, when we look at bull put spreads, we're going to sell one, buy one. We want it to stay above both of them, above them both, right? In fact, with a credit spread, if you're at expiration, I'm glad you brought that up, Stephen, because I don't think I have this in my slides. If a credit spread at expiration is in between the two strike prices, the one you bought's going to expire worthless. It didn't help you. The one you sold is now slightly in the money. You are going to be assigned unless you close it. So if we happen to stay in the trade all the way to expiration, do we need to be diligently watching it in order to close the trade and not let assignment happen? Yes, I would much rather close the trade, take whatever loss there may be, and wind it down than leave it open, get assigned, and then have a whole new can of worms to deal with come Monday morning. So we'll talk about that. Calendar spreads, time decay becomes your ally. Actually, this is wrong. I just realized you're probably not paying critical attention to it, but the way that we do calendar spreads, we do them as long calendar spreads, which means you're actually going to sell the near-term option and buy the further out. What does that do? The near-term option will hit its time decay acceleration first, and it will decay at a faster rate than the one you bought. And that creates time decay in your favor. So I apologize. I didn't realize my slide was off. Although if I go back and I listen, I bet I recognized it was off last time and then I forgot to change it. And I'm thinking there's probably a chance I'll do that again. So hopefully not. Advantages of trading spreads. Number one, you reduce directionality. So what does that mean? It means you hedge against outright directional bets. You don't have to predict big 5 to 7% moves every time. It's tough. That's hard. It's nice to have a little cushion where it's like, hey, you know what? As long as this thing takes at least 8 to 10 days, it'll get better and better. Right? It will get better and better. So that's important for us to recognize, is that we're less susceptible to directional changes. And we haven't talked about the Greeks yet, but we will, but that is delta. And we're more susceptible to time and implied volatility changes, which are theta and vega. Theta, time decay; vega, sensitivity to changes in implied volatility. Okay. What else? Capital efficiency. Instead of buying options or selling naked puts or buying covered calls or buying stock, all things that tie up significant chunks of capital. Even buying options, right? Even buying options. If you look at, like, if you ever look to trade an expensive stock, $800 stock, it's very difficult to even buy out of the money options. But if you start to look at spreads, you have the ability to make anything in the range. So that's good. We have the ability to trade volatility. So you can profit from increasing volatility. That would mean we want Vega positive. That's buying options. That's calendar spreads. Or we can capitalize from volatility decreasing. That's Vega negative. That would be credit spreads, butterflies, iron condors. We have a matrix that we'll go through as we get towards the end of this, and that I'll share with everybody, where we really look at, if I think the market's bullish, bearish, or neutral, if I think volatility is here, right? And we kind of say what trades make the most amount of sense based on those characteristics. And lastly, it gives us a defined reward and risk. It's a defined profit. It's a defined loss potential. It makes it easier for us to quantify and contain and control our risk levels. So, okay, what are the risks then? What do you have to be careful of? Correlation risk spreads rely on the expected relative movement of options. Unexpected correlations between underlying stocks or option prices can impact profitability. Yeah, it's just kind of saying, like, you're at the whim of the stock, and sometimes the stock doesn't move in as predictable of a fashion. So, you know, there's nothing we can do with that. Liquidity risk. Well, you're trading two contracts and you're trying to do it simultaneously. Ideally, in a liquid market, this provides you with an advantage because you're both a buyer and a seller. The market makers love you. Even though it's not the exact same contract, you're still bringing business on both sides, which means they have a tendency to increasingly fill you at the mid price, right? Remember, we have a tendency to buy the ask to sell the bid. Well, I'd like to split that if I could. How do I do that? Well, I try to place my orders at the mid. I have a greater likelihood of getting that when I'm trading spreads. The Greek factor. Well, understanding option Greeks like delta and theta and vega is very important. If you don't, and you happen to enter a credit spread when the volatility is low, or if you buy options when implied volatility is high, you're going to find yourself on the wrong side of the Greeks, and that's important. I actually don't necessarily think I consider this last one a risk. Active management. Everything requires active management. We're traders. I'm gonna throw that out. I'm gonna get rid of that one. So when looking at doing a spread, how does one calculate where to place the strikes and expiration date? I'm more interested in sideways spreads to place these values. KO is a stock that moves very little. Now, here's the hard part, though. If the stock doesn't move very much, then the options aren't going to be trading for very much, which means that when we try to sell, we're not going to get paid very much. Here's what I would say about that. As far as expiration, time is now on our side. And we're not long-term traders, right? We don't tend to put things on for more than 10 to 14 days. Now, if I put a spread on and I'm up 50 to 70% and it's just doing great and it gets to my target, do I think, you know what, I might push it? Yeah, I might. Strike prices, those are going to, you're typically going to be near the money. So at or slightly out. But what I would say is this, and we're going to talk about this a little bit more, the model. How do you determine, well, you put one on and you say, what if I did this? And you say, well, I'm selling, I'm going to go out 30 days and I'm going to put this spread on. And you say, oh, okay. What if I did this spread? And you can do 3 or 4 what ifs. And you could look at where you think it's going to go if you're wrong and how much you would lose. Then you think, what will it do if I'm right? How much will I gain? And as you start to build those, you start to think, you know what, this is what makes the most amount of sense based on how long I expect to be in it. So there's no rule that says if A, then you should be. There's so many moving parts that we have to get comfortable playing with it a little bit. On every single option trade I do, I'm going to play with it a little. I'm going to tweak it a little. What if I went out of the money a little further? Well, if I go out of the money a little further and my trade deteriorates, going out of the money further than that isn't going to all of a sudden reverse it. That's it. That's not the right way to go. If I go in the money and it starts to make a little bit and it starts to show better potential, then I think, oh, I'm onto something. Same thing with time. If I say, oh, I'm going to go 2 weeks and then I go 3 weeks and I'm like, oh, it got better. Great. Well, let's see 4 weeks. And you can just sort of play with it. That's the great thing about an option pricing model. We're not going to have time to dive into it today necessarily, but that's what we're doing on Tuesday. That's exactly what we'll do is I'm going to show you how to use the model to test it and try it. You got to try it. I don't know if that's the right strike. It might be 3 wide instead of 2 wide, or it might be 3 weeks instead of 4 weeks. It's hard to say, but having access to a sophisticated pricing model like we do with Thinkorswim, or hopefully you have something that you're using that is similar to that. What I would say is it's going to be instrumental in helping you to figure out what works best for you. And I'll tell you, I've had times where I've shown other traders what I do. They're like, I don't like it. Great. Don't do it. I've had times where guys show me what they do and I'm like, yeah, that doesn't jive with me. Great. I don't have to trade what they're trading. They do. If it doesn't make sense to me, I'm not going to follow the rules. I'm not going to, but so that's how I would answer that question. Hopefully that makes sense. Okay, let's talk about credit spreads specifically. What is a credit spread? A credit spread involves selling one option and buying another, same expiration, aiming to profit from the difference in premium, meaning that's what gives me the credit. So I'm going to sell one. That's the driver that initiates it. Then I'm going to buy one. Okay, I am going to take a quick pause here because I don't want to not go to the platform at all. Actually, give me 1 second. I'm gonna. Woo! Did you see Apple today getting an antitrust suit? The market did not like that at all. Not even a little bit. So many things have already moved. AMD still pretty close. We could maybe look at AMD just for fun. Oh, I think my arrows are working again. Hallelujah. PLDR. These are all the ones we've been watching, and we've been looking at these signals, and they're doing great. So I hope some of these you put on because they're looking phenomenal. Look at these things flying, but they're not going now, right? It's not now. We don't want to be late to the party. CrowdStrike. Ooh, that's not bad still. Nice little spread trade there. Crowd and AMD so far for me. A lot of the industrials and the financials and the consumer discretionary are already, hitting some, already moving. Would I look at AFL, Aflac? Ooh, we used to watch Aflac, but then we kicked it off for AIG. Aflac and PayPal, yeah. Bitcoin, nah. Look at Home Depot, silly son of a bitch. Oh, IWM. I said IWM is getting ready to go. Meta. Okay, I think I'm going to go with one of those two. AMD, CrowdStrike, just because it's closest to a potential signal. Picard. We love Picard. That was a great one. PLTR. It stalled a little, but I still think it looks fairly bullish. Okay, let's look at PayPal. PayPal. Yeah, that's not bad. I mean, it's kind of like some of ours that we've looked at already that's moved a little. Aflac. That's a hard one. I just feel like AIG has such a better. This thing just got crushed on earnings, and it's worked real hard to get it back. Almost all of it. But now where is it? Now it's right back at that $86 resistance. I feel like I would want to see this thing, if nothing else, pull back first to give me an ability to assess the sellers and see what kind of a cycle they're able to mount now. Yeah, I think they both look fine. AMD volatility's pretty high. CrowdStrike, not as high. Let's just do AMD. This is not a trade. This is not a recommendation. This is not an alert. This is an example. Please use it as an example. We have a setup, meaning it's been in for 3 days grinding along this old resistance level. The stochastics looks like it's ready to turn. Early in the day, this looked great, but at the end of the day, it did not hold on, right? So for me to want to trade this, let's just be super clear. I would need this thing to pop back up. Okay, now I can go. Now I can have a stop down here. There's my risk. Target up here. There's my reward. There's a 3-to-1 right there. Yeah, something along those lines. But for now, let's just kind of recognize that it's setting up, but it has not triggered. What else do I know? Well, the volatility is not at the highest point, but it's definitely in the middle range. It's not low. For me personally, I don't assess volatility as low, medium, high. I assess implied volatility as low and not low. That's it. It's low and things are cheap. Lovely. It's not low. Things aren't very cheap. Do something different, right? That's it. Okay. Real quickly now, what am I going to do here? I'm going to sell something and buy something. So if I'm a little more aggressive, I'm probably going to maybe come across here. And that's not what I meant to do. Hold on. I would probably say maybe around the 180 mark, which is around the money. Somewhere around there. Is that 180? Oh, that's 184. That's way too high. Where's 180? Oh, it's down here. Yeah, 180. I sell the 180 and maybe I buy the 175. Let's look at something like that. What's the low here? The low here is 174. Yeah, okay. So let's try that. I'm going to look at a bull put spread on AMD. So I'm probably going to go out 30 days-ish. So that's going to put me at April, the standard Aprils. Why am I not typing this in? Come on. AMD. Yes. What are we going to do here? I'm going to change my spread to a vertical. So anything we're doing today or Thursday or next Tuesday, no, Tuesday, Thursday, or for the next 2 weeks, we're doing verticals. If you notice here, here's calls again, right? Here's puts. If I'm working off of an ask price, I'm buying something, right? So these two are my debit. I'm buying it. It's costing me money, a debit spread. So a bearish debit spread is a bear put. A bullish debit spread is a bull call. Those are your debit spreads. That's not what we're doing right now. We're doing credits, which means we're looking at bid prices. Credits are here. Now, remember, we said that there is a bear call credit spread. That's not what we want for this. And there's a bull put credit spread. Ding, 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 winner, winner, chicken dinner. Okay, and what did I say? I said we're going to sell the 180, buy the 175. When I click this price right here, that's what it's going to do. Now look down here. I clicked it one time. I didn't double click it. Clicked it one time. Come down here. What am I doing? I'm selling. Now this is 10. Let's drop this to 1 so it's easier to quantify it all. I'm selling the 180 and I'm buying the 175. And if I do that, I'm going to get a net credit of 250. 250. What's the most I can make? The credit. Any option strategy that produces a credit, that is maximum gain. The credit is the most you can make. Cannot make more than the credit. What's the most you can lose? The difference between the strikes minus the credit. 180 minus 175 equals $5. Minus the credit equals 250. So you're thinking, wait, Scott, are you saying I'm doing a 1-to-1? No. 1-to-1 theoretically by max loss and max gain. We don't look at things in max loss and max gain. We look at where am I right? Where am I wrong? What am I going to do? Right? So on this trade, I'm still going to get out if it drops down to 174. We'll even say 173.50. If you look at 173.50, I'm not losing I'm only losing $55. So now all of a sudden, when we go look at the risk profile, bing, what do I have here? Well, now there's my stop live target. That's all I need to see. So I'm going to move these so I can see mostly what I have on my trade. If you put your mouse in the middle and you click, you can move the chart. If you put your mouse on these numbers and you click, you make it bigger or smaller. Oh, this platform is amazing. It's amazing. Now, there's my loss. Real quickly, as you look at spreads, you'll notice I have a purple line and I have this, this black line. Now, those two in relation to each other show you very quickly time decay. When the black line is above, that means time is decaying like this, up. If you see the black line below, it's decaying the other way. So this is a pretty important point right here. And I'm saying I'm willing to let it go all the way out to here. The problem is I'm in a negative time decay situation. So I need to make sure that I give it some time. So I'm going to give it a week. Tomorrow is the 21st. Nope. Tomorrow is the 22nd. I'm going to give it to the 29th. And you'll notice that on the 29th, if I'm wrong, I'm losing $50. And if I'm right, and it gets to my target, I'm making 150. That's 3-to-1 without time decay. But remember, time decay. So if I come here and I start advancing time, you'll notice, look at that purple line. I'm moving it one day at a time. Another day, another day, another day, another day. The longer I'm in it, the better it gets. That's certainly something that's important to me. But I have 3-to-1 right now. No problem. 3-to-1. Great. What's the next thing I should do? I'm going to position size it. I'm going to say, you know what? I'm going to do 4 contracts because I'm willing to risk a couple $100. So I'm going to do 4 contracts. Now there's 200. Yeah. Now, theoretically, I have $250 a contract. So theoretically, I can make $1,000, but I'm not really looking at 1,000. I'm looking at 250 or 600. That's over here. If it gets up to my target, and if it takes, an extra week and a half, I'll make even more. I'll make 750 instead of 600. The longer it takes to get there, the better off I am. Time is on my side. What else? Volatility is negative, vague and negative. It's actually pretty flat, right? It's actually pretty flat. And what that means is volatility is not having much of an impact on this trade. Great. So what we've done is we've made this trade so that time is working for us and volatility isn't doing much at all. Awesome. That's exactly what I'm trying to do. And what have I done? I have a 3-to-1. A 3-to-1. Now, what if I just buy the option? Let's just go back for a quick comparison. And let's say that I decide I'm going to buy, out of the money. If I go here and so now I'm only buying the option. I'm going to bring it down to 1 contract. With 1 contract, I'm risking $375 to potentially make 1,084. And you might be thinking 1,084 is pretty good. 2.89. My other ratio is 3. And this ratio gets worse and worse and worse. An extra week, and now I'm barely better than 2-to-1, 1,000 to 469. Why? Because time is hurting me at $22 a day. And it's going to get worse. 22, 23, 24, 25, right? And it gets worse and worse and worse. Every day a little worse. What are we doing? We're taking that out of the equation. I'm putting time on my side. We talked about how I can do better. I can risk 2 to make 6. The best I can do here is risk, right? Risk 300 to make barely over 1,000. So it's lesser reward to risk, lesser probability. Why? Because the implied volatility is high. Because expensive options are harder to do as a buyer. That's the gist. So hopefully that helps make sense. That's what it looks like right there. I'm gonna paper trade this potentially. We'll see if I get 250 tomorrow or not. We tried to do a paper trade on our covered call on PLTR. We missed it by a few pennies, and it would have been great. Anybody placed that one, let me know. Okay, let's go back to our slides. Let's wrap this up. Okay. Where are my slides? There we go. What did we do? We sold, right? We picked the sell first. We picked the 180, which was right at the money. So based on the example, we should move expiration out to increase our profit. Not necessarily. No. Let me show you why. Okay. Let me bring this back up. Analyze trade. Now, if I take this out to May, okay, let me unlock this. I'm getting 250 in theta. If I go out to May, look at my theta. Nothing. Nothing. In fact, you'll notice in May, my credit actually dropped. I'm getting 250 in April, and I don't know why, and this is very odd, and it might just be because at night they've moved their spreads a little bit, but no, that's not true. We don't want to sell more time because more time gives us more credit. More time means more credit, but it means slower to get the credit because remember how time works. Time works on an inverse exponential. Why can't I draw? Let me draw a line. Let's make it red. So time, it starts off like this, and then it drops off like this. So if I sell, 30 days, I'm hopefully catching some of this. If I sell 60 days, the first 30 days are here. It's hardly losing anything from time in that first little bit. So no, I tend to be only about 30 days out when it comes to that. There's no benefit to us selling somebody else more time for them to be right. That's the way I would look at it. Great question. I appreciate you asking it. Okay, so we sold the 180. That's the driver of the trade. Let's just say that gave us a credit of 350. Then we bought the 175. That's underneath. That's just in case this thing falls off the planet. I'm only liable to 175. I can't get worse, right? So I paid $1 for that. So instead of doing a naked put at 350, I did a bull put spread at 250. My margin requirement reduced significantly, and that's the advantage. Yeah? I hope that makes sense. Bull put spreads. That's what we looked at. Profit when the underlying rises or remains stable. We did an example of that, reward and risk. You saw the reward to risk ratio is about 1-to-1, but when you put your stop and target in there, we're hoping to get at least 2-to-1, maybe even 3-to-1, right? That's what we're trying to do. It's limited risk. It's limited reward. We've changed the dynamics and the variables, particularly in regard to time and theta and vega and volatility. Bear call spread. What are we looking for? We want to make money if the asset drops. What do? We sell an at the money call, and then we buy one a little above us. The above us is just in case this thing reverses. I have the right to buy it, so I've protected myself. Limited risk, limited reward, very similar risk profile, just flipped. So let me show you what that looks like. So here is a bull put spread. I want it to go up. As long as it gets above 180, I make max gain. If I switch this to a bear call spread, you'll notice everything is different. I'm selling the 180. I'm still selling one and buying one. Or excuse me, I'm selling the 175 and buying the 180. I'm still selling one here, but now I want it to drop. I make my money on this side if the market were to drop. So it's just flipping the script. Right now, we're not going to care too much. In a different market, we most certainly will. And something to think about is that in a market that's dropping, after the first couple of drops in a bear market, the volatility is going to be up at 35%. It's going to make it incrementally harder for you to try to buy puts. If you're going to do puts on a bear market, you got to catch the first wave, maybe the second. Otherwise, the options become untenably high in volatility and price, which means we've got to integrate some type of a selling strategy. So in bear markets, I'm definitely much more inclined to do bear call and bear put spreads. Absolutely. First couple of swings down, buying puts. After that, yeah, you got to be a lot more careful. So be aware of that. Okay, considerations. What do we want? Say that again. Well, I'll tell you what, I completely forgot what I said. What was I just talking about? Bear calls? Bear calls. Oh, yes, bear market. In a bear market, volatility is going to be high. After the first couple of weeks, the VIX is going to smash higher. We've talked about that, right? So once that VIX smashes higher, you're buying expensive options. So I can either buy expensive puts or I can sell expensive call spreads. And I'm going to sell expensive call spreads. Makes sense, right? Do you want to buy an expensive put or sell an expensive spread? As a seller, I want to sell an expensive spread. So there you go. Bear call. Bear call, bear put also works. Remember, we're just focusing on credit now, but it's not that it's statistically better or worse. It's just different. We're going to talk about that and go from there. Okay. What do we want to do credit spreads? I want high implied volatility because I'm going to be theta positive, time's working for me, and vega negative. I want volatility to drop. If I want volatility to drop, it stands to reason I want it to start high. If it starts high and then it drops, it benefits me. Margin requirements. I'm going to have a very specific margin requirement. It's not going to change. Margin requirements on naked options definitely can change as the trade goes. Risk assessment. Yes, if you're gonna trade spreads, my rule is this: you have to use a model. Please don't trade spreads without a model. Most have them these days. If you haven't, you can always go with Thinkorswim through Charles Schwab. Phenomenal model. That's going to allow you to assess risk and control the reward, and to lastly be able to monitor and make adjustments. Okay. I'm not going to have much time for questions, but a couple of minutes. So get them started now. Let's summarize this. Option spreads are an extremely powerful tool in options trading. It helps us to manage risk. It helps us to define our strategy, to unlock opportunities for, profit and diversification. But you gotta learn the mechanics. I've seen really nasty things happen. I could tell you a funny story one day. I was traveling with a workshop, and there was I was a coach for this company. I would travel sometimes and just kind of help out. And I was in the back of the room, and one of the workshop, he wasn't the instructor, but he was like the moderator, like the organizer. Anyway, he had a spread trade on that was going against him, so we decided to play a trick on him. And unfortunately, it worked because it shouldn't have. But we convinced him that he was about to have an enormous margin call before we let him in on the trick. It was pretty funny. Anyways, knowledge is key. Would I leg out of a trade if it's making money? Oh, that's a great question. I really tend to view spreads as one trade. And unfortunately, a lot of people talk about like, oh, if it starts to go wrong. So let's say, for example, we do this bull put spread and it turns around and it breaks support. And we're like, oh, it's going down. Well, I could theoretically buy back the option I sold, and that would unwind it to just be a long put, which would make money if the market drops. Here's the problem with unwinding things, is I'm taking a loss on the first option. And if I do that and then the market whipsaws, I'm going to take a loss on the second option. And when you combine those two losses, they're going to be 5 or 6 times bigger than you thought max loss was going to be. So anytime you unwind a spread of any kind, like you take a leg off, whatever you thought you were doing from a risk standpoint, you have just significantly altered it. So I prefer not to. It's appealing in like, oh, all you have to do is this, just switch it. It's great. And then you can ride your unicorn through the gumdrop forest. So there you go. I'm going to say the trade is the trade. When it's wrong, it's wrong. Now, if, for example, you do a spread and it goes way in your favor, and you can take profit on one side and you have just a worthless other side, and you can just leave the other side open to potentially recover, sure. I don't think you'll ever see that. So I guess if you come across that, hell yes. Hell yes. In our example, AMD closed at 178. If we feel it will drop lower, should we set the strike closer? Not should, but could. Meaning, if you did think it wasn't going to get as high, you should test different strikes, and then you look at what would the reward to risk ratio be. But in order to do the reward to risk, you have to have some idea of a stop and a target in order to give some level of quantification. If you don't have that, then with the spread, you're just going to rely on max loss and max gain. And if you're relying on max loss and max gain, your reward to risk ratio is never going to be good enough. We don't trade one-to-ones, and yet that's what the reward to risk looks like. A lot of people are like, oh, I don't do spreads. The reward to risk isn't good enough. And I'm like, what do you mean? They're like, yeah, if I do this, I'm risking this for this. And I'm like, yeah, max loss, max gain. Are you telling me you're just going to put the trade on and sit back and wait to see if it either gets to max loss or max gain at expiration. I don't think that's what we're going to do. I'm pretty sure we're going to look at it every day and manage the trade. So I don't look at spreads as max loss, max gain consideration. I look at them as what's my loss and my gain based on time and the variables that I have come up with, meaning my stop and my target. Okay, now what? Paper trade. I mean, honestly, like I would do at least 10 paper trades on any strategy that's new to just test combinations, figure out like, do I know the orders that I'm going to be using? Can I manage with orders, etc. And make sure you're utilizing price models, Black-Scholes, binomial, Bjerkson Stenslin, whichever model you're using. I use Bjerkson Stenslin. That's Thinkorswim. Interactive Brokers uses Black-Scholes, whatever. Use a model. There's too many moving parts. You can't memorize. You can't do it in your head. You cannot do the math in your head. You got to have a model that's doing it for you to make sure you're running things the right way. Okay, that's it. I gave you 2 minutes for questions. 2 minutes. Steven said, I'll send you an email on AMD specifics to address my concerns. Love it. Love it. I mean, I may use your email to start us off on Tuesday. So I love it. I look forward to it. Please. Please. Anybody else? Like I said, if this felt like a lot, it is. If you don't have the building blocks, it's going to be much harder. So go back and get those building blocks. Go through the terminology, the key concepts, go through the basics, go through the selling, get all your blocks in place so that you're ready to go with these blocks. Any other questions? You guys are amazing that you stayed through it. I bet half of you are maybe asleep. I put you to sleep with this options nonsense. I hope not. I hope you embrace these. Does it take a little bit to get real comfortable? Yes. Unfortunately, yes. Is it worth it? Again, yes, it's worth it. I promise you that. And it's a great challenge. I know a lot of people that trade, they're not just doing it for the money. They're doing it because they enjoy it. They enjoy the market. They enjoy the challenge. If that's the case, options is going to open up a whole new world for you. So anyway, all right. Well, listen, that's it. Next week on Tuesday, application. We're going to build 3-4 credit spreads, etc. And then on Thursday, we'll switch gears from credit to debit. So there you go. All right. It's good to see everybody. Have a great rest of your night. I'll see you tomorrow at 3:15 p.m. Eastern to wrap up the week. We'll watch the market close in the last hour together. And then on Sunday, we will move back to, we will have our regular time. A quick heads up to those who are here. And maybe if I say this, you'll remind me. Don't let me forget. I have a personal conflict on Monday and Wednesday that's going to cause us to just have to push our start time back. So instead of going 15 minutes before market, we're going to go half hour after it opens. I'll send it out and make sure everybody remembers, but I do have to push our start time back on Monday and Wednesday. So bear with me for that. Hope everybody has a great rest of your night. It's great to see you as always, and happy trading.